GameStop is expected to announce its quarterly earnings on Tuesday, March 23rd after hours. And in this video, we'll be talking about how to find its expected move in the options market and then what that's going to look like on the chart. As the sign says, I'm not a financial advisor. And if you guys have a pet, let me know its name down in the comments below because I am curious. GameStop in previous quarters typically moves around 11% on earnings. However, there is actually a way to calculate the expected move for upcoming earnings using the options market, and we are going to do that right now. The way that you calculate an expected move for earnings is a very simple math equation that I will put on the screen as I go through it so you can follow along. So the first thing that you're going to need to do is you're going to need to go to the options market and you're going to need to go to the closest expiration date. So in this case, we are looking at the March 26th expiration date because that is this Friday and earnings for the company are on Tuesday. Then what you're going to want to do from there is look at the first strike price that is out of the money. Basically, what that means is the strike price that is right above where the stock is currently trading. So in this instance, the stock is currently trading at 194, which means that we will be looking at the strike price of 195. So what you do from there is you add the call option and then you add the put option. You add those two numbers together and you should get around 59.55. From there, you multiply that number by 0.84. Why 0.84? Because that is the numerical number for one standard deviation, which is what the strike price out of the money currently is. I don't make this stuff up. I'm just using the math equation that works. And then from there, you divide everything by the current stock price, which is around 194. So if you did that, if you did it correctly, you should end up with a fairly small decimal number that is like 0.257845, etc. Right? So obviously 0.257 is not the expected move. We have to turn that into a percentage. And the way that we do that is we multiply that by 100. So in doing so, you then get a number of 25.78%. That means that the options market is expecting around a 25% move in the stock after earnings. Now, a couple things to know is one, this 25% is not a guarantee. It is just what the options market is thinking is going to happen. And two, this percentage move is not a guaranteed upside. This percentage move could also be 25% to the downside. So keep that in mind. Now let's go take a peek at the charts to see what 25% as well as some other percentages would look like. So as you can see on the screen right now, we are looking at the 20-day 1-hour chart, but in all reality, the chart actually doesn't matter because we're really only going to be looking at the percentages. So currently the stock is at around 195. It has moved because it is currently the trading day is open at the time of recording this. So 195, let's just go up 25% and see where that puts us. If we were to go up 25%, which for some reason I can't find. So if we were to go up 25% from the current stock price, we are looking at a actual price of around 260 to 261. Now, granted, can it go above that? Yes. Can it not reach that? Yes. This is just a prediction of what the options market thinks. Now, like I said earlier, this can also mean 25% to the downside. So what does that look like? 25% to the downside puts us at around 156. Not great, but obviously it could be worse considering how volatile the stock can be. So that's like the super high and the super low end of where the options market is expecting it to go. And as I mentioned earlier, the average move for this stock is around 11%. Let's just, rein in our expectations a little bit and let's see what 11% is going to look like on the chart. So 11% to the upside is going to put us at or around 217 and change. Which is, I think, a good sign because I think that this stock needs to get over that $200 mark for a couple of reasons. And the main one being that it's just a psychological barrier. That's just one of the things that stocks have trouble getting over. It would be like even numbers, whole numbers, 50s, 75s, 100s. So getting above that 200, especially with earnings, hopefully a decent pop should be a good thing for the stock. Now let's look at 11% to the downside. 11% to the downside is at around 175 and change. Not the worst thing in the world. We are still close to that to 200 level, so it wouldn't be impossible to get back there. But that is the average expected move. And as you can see right now at the 175, I'm just going to quickly draw in a price level at 175 to show you that if it does drop below there, you can see we've touched it. We've literally bounced off of 175, and we did it today actually, because this is today. This was last week. This was a couple weeks ago. And actually, if I extend this to the left real quick, you can see that as we tried 2-ish weeks ago, we were hitting 175 as resistance back here. So if we do happen to go down in the 10 to 11% range, I would definitely look for that 175 to be a solid line of support. So hopefully you guys found this video helpful, not only for finding GameStop's expected move during earnings, but you can also use that math equation on literally any stock that you have exposure to or don't have exposure to. You're just curious about what you think the stock would move. That equation is great for if you want to play a stock on earnings, albeit with options or shares, etc. That's just a good way to see if it's worth it. And I know I didn't go too deep into the options realm and world, but I am starting a options series all about options in terms of everything you need to know about as a beginner, to everything to like how to play certain strategies, why, all of that fun stuff. So if options are interesting to you, feel free to stick around because I'm going to be producing a ton of option content soon in the near future. And as always, I will see you guys next video.